Well, a widely forecast recession has yet to make an appearance in the U.S. and may never come at all. If smaller nations are any indication, the Federal Reserve could bring inflation down with minimal pain. Goldman Sachs economists have tracked a group of 9 so-called early hiker nations whose central banks began raising rates as early as 2021 to tackle rising inflation. For reference, the Federal Reserve began their hike campaign in March of 2022. And many of those smaller early hiker nations have avoided a recession. Does that mean the U.S. can accomplish the same? Courtenay Brown is an economics reporter at Axios. She joins us now, and she's the one who pointed out that look from Goldman Sachs. So what are the lessons we can kind of learn from those other early hikers?
Well, there's been a lot of discussion around lags, and the Federal Reserve has raised rates at a historic pace, and there are lots of questions about when that is going to fully impact the economy. But here we have an example across a set of 9 nations that Goldman Sachs has been tracking. They raised rates in early 2021. It's, I think, safe to assume that the so-called lag effects have already hit their economies, and they've both seen inflation, broadly speaking, both seen inflation come down to more tolerable levels, and they've also avoided a recession. So what does that mean for the U.S.? Is it possible that the same could happen in the U.S.? And Goldman Sachs seems to think yes. There are a few caveats, though. I talked to a few economists who said, well, let's be careful here because an interest rate hike in Chile, for instance, is not the same as an interest rate hike in the U.S. Not all rate hikes are created equal, so the impact that a rate hike would have on one nation doesn't necessarily mean it's going to have the same on the other nation. But it is interesting to see that there's been this flip. In previous economic cycles, these emerging market nations weren't usually first to raise rates. This time they were the first out of the gate to raise rates, going several months earlier than other developed nations have. And they seem to, for the most part, have avoided a recession. So maybe that can make us feel a little bit better about our prospects here in the U.S.
Yeah, and you also wrote about this period of kind of post-pandemic policy from different nations, whether they're late hikers or early hikers out there, and how that could lead to this period of immaculate disinflation. Can you break that down a little bit more for us?
Right. So I think when the Fed started raising rates, even policymakers at the Fed seemed to imply that there's going to be some pain for households and businesses. If you remember almost exactly a year ago, that very daunting speech from Fed Chair Powell warning about pain to come from the Fed's moves to bring inflation down. But here we are a year later, and there has been relatively little pain. We have a very solid labor market. We have a very, hopeful view that disinflation can continue. And that kind of doesn't align with the historical record. And so is it possible that history does not have to repeat itself? We can kind of follow what these emerging market nations have done and also avoid a recession here, just because of some of the weird post-pandemic dynamics that are at play.
Here's hoping. And then sort of related to that is the question of whether we can believe the metrics that we do have to measure inflation, or if not believe them, if we need to understand them better. I mean, one of the things that you point out recently is the effect that leisure and hospitality job dynamics is having on wage numbers as an input, of course, to inflation. And because they're sort of lower paying jobs, some of those dynamics might have an effect on the wage numbers,
right? I love this question because it is so interesting that we have these weird fluctuations in the economic data and in the economy at large because we're still adjusting from the pandemic recovery. And economists, they're not saying that, the technocrats at the BLS are making up numbers. That's not what's happening. But because of these pandemic era distortions, should we take this data at face value, or should we ask a question like, are wages rising because there's been a slowdown in hiring in leisure and hospitality, and that's kind of flipped on its head from what happened last year. And so maybe this isn't the best wage number to pay attention to. Maybe we should look at the employment cost index, which is widely believed to be a more thorough measure of wage growth. Because when you look at the jobs report, it was very favorable. Everything that the Fed really wants to see, but it was that wage number that kind of freaked people out. Oh no, our wages reaccelerating. But let's take a step back and look at other wage data. Let's not take the average hourly earnings number at face value.
Yeah, and I mean, this has been kind of a boom in employment for leisure and hospitality that has still been trying to get back to those pre-pandemic markers, of course, and in some of the other areas of the economy, too, where there is that fight for wages so that employees who are very well knowledgeable and tracking or perhaps at least discussing at brunch the word inflation and what their belief or understanding of it might be, how that also leads them to negotiate differently when they're looking for a salary or looking for a new job elsewhere too.
Yeah, I think that is one of the most interesting questions that we're going to watch. Like, what are the wage growth dynamics as the economy continues to normalize from this, post-pandemic weirdness, if you will. And yes, there is it's very clear that there's still a lot of demand from employers. And so will employees say, you know what, I've lost out on real pay gains for the past 2 years, and it's time for me to make up what I lost, and I'm going to demand higher wages. And because the labor market is so tight, do employers say, I guess I have to give this to you because I need workers? And does that kind of accelerate inflation in a way that the Fed would be uncomfortable with? And that kind of makes the story about, can we avoid a recession? Yeah. Can disinflation continue? I mean, that's a big debate that European policymakers are having right now, less so in the U.S.
Maybe at the Brad Smith brunch indicator also, maybe you're having that debate there too?
We are, actually. Every single week. It's right after our Barbenheimer conversations usually take place. We've got an annual update on that. Everybody's invited. Courtney, thanks so much for joining us in studio.
I'm glad to know I'm not the only one having these conversations at my brunch.
Everybody should be. Everybody should be.